video, I'm going to talk about annuity payout options. So basically, say if you own $1 million annuity, how would you like to take your money, right? So it's I'm going to show you some examples. It's going to be fun. Okay, first is straight life income. It's also called a pure life income. So let's see, say fixed equal payment over the life of the recipient, and it would be guaranteed not to run out as long as the annuity lives. So okay, let's see example. Say you, age 60, currently own $1 million annuity contract. So when you select the straight life option, so insurance company say, you know what, I'm give you $100,000 per year for your rest of life. So, however, if you die, nothing left. So this thing coming with the characteristic, say, because this type option, then because it's straight life, you take it, it's only for your life. Then you die, nothing left. So this pays highest periodic income payment. So insurance can promise you $100,000 per year. So that's highest periodic payment. So appropriate for the contract owner without heirs. So if you are a single person, that's all you want. You want a life income as high as possible while you live. When you die, you don't care. So then that's the best option for you. No residual value at death again. So you don't worry about, say, prevent any portion of the remaining proceed from being included in an estate. When you die, nothing left, so nothing to include in your estate. Then no beneficiary designation. You're not living anything, so no beneficiary designation. So actual tables are used to determine the life expectancy, and earned interest is also assumed. In most cases, once this option selected, it cannot be changed. Okay, so in this a little example, I can show you exactly how much the interest rate. Say if you live till age 90, so for giving this scenario, you're $1 million, currently you are 60, then you take a straight life $100,000 per year, so you would earn 9.31%. That's your annual interest rate you can earn. So given the life expectancy to the 90, if you live to 100, the interest rate is 9.76%. So you can see the longer you live, the beneficial you have. You can see if $1 million, you take $100,000 per year, 10 years, you already get the $1 million back. So everything else beyond that, so it's your gain to you. So you can see, live to 90, you get annual return is 9.31%. You live to 100, you get annual return is 9.76%. So, however, if you're living short, this year is 60, age 60, you take the payment this year. So a year later you die, you only $1 million. Then you only get $100,000. You die, then nothing left. So that's the lose to you. So this is kind of their annuity. You have to understand annuity is to protect you when you're living too long, right? So it's for your life. So that's the concept there. The longer you live, the beneficial you have from the annuity products. Okay, so this is straight life income option. Then we talk about the life annuity with period certain. The period certain is the minimum number of the years the payment will be made, even if the recipient dies. So basically, what's the situation side? Again, the same example. You 60, you own $1 million annuity contract. So period certain side, you know what? You have family. So you want you don't want that you die after a year, right? Then you have nothing left. So that's not good for your family. So basically say, you know what? I want a 10-year certain, which means say insurance company now, instead pay you $100,000 per year, they will say, I'm going to pay you $80,000 per year. However, I'm going to guarantee for 10 years. No matter you live or die, I'm going to pay you or your beneficiaries $80,000 per year. So within the 10 years, if you die, your family, your beneficiary will receive the rest balance. They will receive $80,000 for the rest of the 10 years, right? So beyond the 10 years, if you die, nothing left. However, if you live beyond 10 years, the $80,000 per year still there as long as you live, you still get the $80,000 per year, but you just get the 10 years guarantee. So that's the most scenario when you have a family, then you worry about if you die too soon, nothing left. So that's the life annuity with the period certain. So the annuitant selects the beneficiary who will receive the benefit payments if the annuitant dies before the end of the period certain. That's what we exactly said. If you die before 10 years, the beneficiary will receive the monthly payment, to the end of 10 years. If the annuitant is still alive at the end of the period, the payment continues to the balance of their life. If you live 200, the $80,000 still there. Because there's a guaranteed benefit, this will pay out less per month than the straight life income option. So you can see compare the previous straight life. So you get $100,000 per year. So in this situation, the insurance company said, you know what, I'm not going to pay you $100,000 because I have to guarantee for 10 years. So then they they will reduce your monthly payment to $80,000 per year. So this is life annuity with period certain. Longer the guarantee period produce lower income payment. Of course, if you want a guarantee for 20 years or 30 years, insurance company probably will reduce your annual income further. So next is life income with refund. Okay, what is it? With this option, the monthly income is paid during the life of the recipient and pays beneficiary unpaid balance in a lump sum at annuitant death. So basically, the situation like in this example, let's say you choose life income with refund. Your $1 million, let's say, is a annuity cash surrender value with they say $80,000 per year. Okay, so let's say if you die in 10 years, you receive this income for 10 years, so you get $800,000 out of this $1 million, right? So you have a remain $200,000. So if you die after 10 years, the balance will go to your beneficiary. Of course, the earlier you die, the larger the balance is. Whatever you have been paid, then the difference from the surrender value so will be paid to your beneficiary. That's basically how they say it. If they die before receiving accumulated payment equaling the original death benefit or cash surrender value, the balance is paid to their beneficiary. So if you die like in a year, so if you receive a payment $80,000 per year, so then you die a year later, so you have $920,000 left gonna go to your beneficiary. Because there's a guaranteed benefit, less will be paid out per month than the straight life income. Well, you can see here, insurance company won't pay you $100,000 per year. They only pay you $80,000 per year if you choose life income with refund. Okay, this one is joint survivor life. Joint survivor life when you have spouse, right? When annuitant wants income to last as long as either one or two people is alive, is joint and survivor option should be selected. You have a straight joint, say, and survivor, straight joint and survivor option, which is pay one amount as long as either person live. In situations that you and your wife both age 60, you own $1 million annuity. Insurance company say, straight joint, say, okay, I have to guarantee, monthly payment either of you live. Okay, in this situation, so insurance say, I'm gonna guarantee $60,000 per year for life. If one person's life, so you may die, you have a high probability to die. Let's just say one person, you may die at 70, 80, right? Two people, you may have, the probability two people die early is less, right? So basically, if you want to guarantee two people's life income, then the life income amount will be much less than your single life. You can see insurance company only want to pay you $60,000 rather than you can see straight life is $100,000. So this one is only $60,000. So that's straight joint. The $60,000 is for the rest of your two people's life. This amount is fixed, no change. However, there's other options, say joint and a 2/3 survivor option. Will pay amount as long as both people are alive, with 2/3 of original payment continue for the survivor life after others die. For this one, basically say, okay, so I will give you, when you both alive, I give you $65,000 per year for two. So then if one die, I give you the rest is $40,000 per year. I'm going to reduce that. You can see, okay, this calculation is $40,000 is kind of, okay, it should be is 2/3 of this one. Anyway, so this is kind of 2/3. Okay. So basically say, if you live two, so then I'm going to reduce to 2/3 of this when one alive. So that's basically how the concept. You can see $65,000 will be a little higher than this because they have to guarantee two life. This one, because you're going to reduce when one alive. So the original should be a little higher than the straight joint. Then the joint and half survivor options. So this one very similar to this. So basically say half is even less. even less, should be 35,000. And so basically say if you both live, I give you $70,000 per year. So if one die, I give the rest is half of this, should be $35,000 per year. So you can see they can give you a little higher when you are alive. So when one person dies, the one will reduce dramatically. So that's how they calculate. So these options provide the lowest possible income level for given sum of money. You can see this compared to previous options. Insurance company won't give you that much. Because they have to guarantee two people's life income. So usually it's the lowest income options. Then have some others, they have a fixed payment. Let's say you $1 million, you fix the pay for 20 years, you can get $120,000 per year. So instead for your life, right? So then fixed payment with COLA, they basically is the cost of living adjustment. Say, I give you, let's say you choose straight life, $1 million policy, then you get $100,000 per year. If you want a guarantee for inflation, adjusted with inflation, then I'm gonna reduce your original payment. Let's say I'm gonna give you $80,000 per year. Then I'm gonna adjust 3% per year with the inflation. So that's kind of other option as well. So overall, that's how that's basically how those payout options exist in the annuity. So some of those options you exist in the life insurance as well. However, this is mainly for annuity.